Because the current interest rates in the market are so high, anytime there's a property that offers seller financing, it goes through the market like wildfire. Everyone gets super, super excited. So in this case, there's an 8-plex on the coast of Oregon that is being offered at a little over $800,000. But here's the kicker. The seller is willing to give seller financing if you do $75,000 down, which is like nothing. And they will only charge 6.25% interest, which is great versus what you can get in the market. And they'll give it to you interest only for the first 2 years with a 10-year balloon payment, and it's amortized as if it's over 30 years, which is also fantastic for a commercial property. So there's a lot going for this thing. And here's the headline that is catching everybody's attention. In the estimate of what they're going to be that you get from the real estate agent, it's got an average cash on cash return of 28.92%, which is just off the charts awesome. It's unbelievable. And spoiler, it is unbelievable. So let's take a look at this property and see what's going on. My name is James Furlo, and I help real estate investors maximize their long-term cash flow while minimizing headaches. Thanks for watching. Here's a quick look at this property. I don't know when these pictures were taken, but the outside looks a little bit dated. I hear there's rumors that there's a new roof on this thing, which it looks like just from the pixelated pictures that it probably needs it. It looks to me like it's a converted single family home into 6 units, which means there's probably funkiness all around. This is an old listing photo of it for unit 2 specifically. So we can just see that there's some nice floors. That looks nice. Ooh, there's some wood paneling. Exciting. More wood paneling. It's kind of got like a gallery kitchen. I think that's what that's called. Very much a smaller place. I think this is a 1-bedroom. There's a studio, there's 4 1-bedrooms, and then there's a 3-bedroom place. And I think this is a 1-bedroom based on what I'm seeing. Okay, you can see they've got electric heat, electric range, and a very small one at that. Look at that. That is tiny. Kind of older cabinets. You know, if I had to characterize this, I would say that is so tiny and cute. I would say it's in good shape, but it's old and would probably need some updating. But overall, I think they've done a good job of maintaining this place. Good job on them. This was the deal sheet that I was given. So you can see they're asking $829.5 for it. It's a 6 cap. Check this out. They said 20% cash on cash return, even though their analysis said 29, but that's okay. Even still, 20%. Oh my gosh, it's crazy. So you can see they've got the studio, there's the beds, there's a 3-bath. Interestingly, the owner is paying for the utilities, which is further credence that this is a 1-bedroom house that was converted into a 6-plex of some sort. So there's definitely funkiness going on there. And then here's what I said they'll structure it. $75,000 down, 6.25% APR, amortized over 30 years, due in 5 years. And then there's a prepayment penalty if it's paid within the first 2 years. I don't know what that is. What I do know is this person is clearly trying to extend out their capital gains tax. Totally makes sense. I totally get it. And they say there's room to raise rents, so we'll take a look at that as well. Here's the A-pod that I was given, and I'll be honest, I don't even remember what that acronym stands for, but essentially it's the analysis sheet that was shared. We've got our price. Here's an interesting thing. Renovation 0. It's in great shape. Don't worry about it. We're going to change that number for sure. Interest only, yes. Interestingly, what I happen to know how the spreadsheet works is that if you put a yes here, it actually is interest only for the entire term of the property, not just those first 2 years. So that's a change that we're going to make when we look at it. Oh yeah, here's our 28.92% cash on cash. And we've got an IRR of 29%. I mean, these numbers are unheard of high. And as we'll see in a little bit, there's a reason for this. But let's keep going down here. Gross scheduled income, $82K, makes sense. They have coin-op laundry, and they're making about $100 a month, I guess. Ooh, they added a vacancy factor of 5%, even though in their sheet it said like it's been 100% vacant the entire time. There's very low vacancy, which is just true of everywhere in Oregon. And then we've got our expenses all down here. No reserves. All right, that's pretty typical, which is fine. We can change that. Here's what our average units and rents are going for. And here's what we think we're going to be able to get for the place. Studio is $1,100, 1 bed is $1,400, and a 3-bed is $1,675. Now, I looked into this, and there's just not a lot of data, but there was one thing that caught my eye, and it's specifically around the 1 bed. Let me show you. This is your odometer. It's not the final say on what things are. You got to talk to a property manager to get that. And their sample size is pitifully small. And they get it, and they tell you, don't rely on this. But what caught my attention is for this one bed, it's only at 1163 or 1150. It's really not that high. And honestly, the range isn't that big either. So I'm going to trust that they talked to a property manager to get this number. Actually, that's not true. I'm not going to trust it at all. I'm going to put in $1,200 because I want to be conservative in my particular underwriting. But I could talk to a property manager and they could say, yep, absolutely, no problem. We can get it for it. I don't know. And I don't know what the size is. There's not a lot for me to compare it to, but that's okay. So what I tried to do was replicate this inside of my analysis spreadsheet to see how close I could get to that average annual return of 29%, which I think it's interesting that they are advertising 20%. I don't know what that means. Maybe that's their way of being conservative, I guess. I don't know. Besides the fact that those returns were astronomical, my very first clue that something was up happened right in my ballpark analysis. So I put in the gross potential annual rent. I typically put in 15% for economic and physical vacancy. They only have 5%. I also typically start with an annual expense rate of 50%. Here's what's interesting about theirs. It is only 31.84%. If I have the market cap, which they gave me at 6.5%, this would say that the valuation should be closer to $548,000, not $829,000. So if we do some quick adjusting and say, all right, let's say that the vacancy is actually 5%, and let's say that the expenses are actually 32%. Now you can see how they got to their number, 832. Boom! It's always kind of fun when the math works out, huh? So the question is, does that 5% make sense? And does that 32% make sense? I put in their numbers except for this one. I kept this at 1,200. It doesn't make sense to put in 1,400 for that. I just don't see it. Again, I could be talked into it, but for now, that's what I'm going to put in. We start with a marketing package. There's all their numbers. There's their vacancy loss. Here's all their numbers, including the things. You can see there's the 31.4% is what I ended up, and there's no replacement reserves. One thing that caught my eye was the repairs and maintenance. It is only 3.7%. This number is too low and needs to be changed. There's no replacement reserves. Those need to be added. And that's really just for ongoing CapEx expenses over time. You need to be saving for those. I do think that there's potential additional income opportunity with these utilities because right now the owner's paying for them. And my guess is because it's a converted house, there's only one option. There could potentially be some build back utilities to get that income back. And so we can take a look at that and play around with it in the future. I'm pretty sure in their spreadsheet that they said to get the rents higher, it's only 12 months and there are no rehab costs to go around it. Here's my mortgage assumptions. You can see it. To go with their spreadsheet, I put the IO period as the entire life of this investment because that's what's inside of their spreadsheet. And right now, all I'm trying to do is match them. And I got rid of all of the syndication assumptions and saying, hey, if I just buy this by myself, just like a regular type of purchase, what would it look like? Trying to get as close as I could apples to apples. There was another assumption that they had in their spreadsheet, which is their annual rent and expense escalator. They put them at 3% each. In my opinion, I think 3% is a little aggressive given most recent history of rent increases or lack thereof. And I think this expense escalator is a little too conservative, also aggressive. Which way does it go if it's negative? Anyways, I think it's too low because currently inflation is closer to like that 4%. And so that number, I would tweak that as well. But for now, we're going to run with what they have to see what the output is. Well, isn't it nice that when I put in and try to match theirs as much as possible, I get really close to the numbers. So you can see I've got an internal rate of return of 18.8. That's pretty close to what they're saying. And the average annual return of 27.2. Again, pretty darn close. And an equity multiple of 3.17. Oh my gosh, these numbers are just off the chart. It's unbelievable, but that's okay. Here's some other interesting data numbers. So there's that blended rate. We have a loan to value of 91%. I mean, this thing is leveraged to the hilt. One thing that's probably an area of concern for me because of this leverage is this break even is at 83%. And we're estimated that we're going to be at 95. So if I'm honest, that doesn't leave a lot of wiggle room in there. And then finally, one of their assumptions is that the current cap rate of 6.5% is going to be the same 7 years from now, 6.5%. This is not conservative, and it's not what I would put in. I would put in an increasing cap rate over time. That's a conservative way to do it, which essentially says that the price you pay for the income you earn is going to be going down over time. It's just a more conservative way. It's inverse of what you would think it would be. But this is their current assumption in there. So they're saying that it's going to be growing at about 4.1% every single year, if you were to think about it from an appreciation standpoint. So on the surface, if we use their assumptions, this looks like a fantastic deal. Let's write it up. Let's go. But I think it would behoove us to make some tweaks and changes and try to get a little bit more realistic on what we actually think is going to be happening, and then take a look at that output. Let's head back over here to our in place. So we keep the marketing package the same. That way we have something to compare it to. This repairs and maintenance of only 3.7%. It's just too low. I'm bumping it up to 8,000. Which gets us closer to a 10%, which is more standard. It also gets me really close to a 40% total expenses. This is a little bit closer to what I typically see in Oregon. And here's what's gonna blow your mind. All I did was increase this by $5,000, and it is so highly leveraged that look what it does to the IRR and your cash on cash return. It just instantly takes them down to just lower levels. And instead of having a more than 3x return on your equity, now it's only a 2x. All I made was that one change. And it all comes down to this loan to value is so leveraged that little changes like that are a big deal. And look at our break even point. It's risen even closer. I mean, this is all of a sudden, just with one change, not as good of a deal as it probably could be. Now what I want to do is really dial in all of the assumptions that I think could actually happen to see what I actually think the return of this place could be, because there's some more to do. For starters, this annual rent escalator, I'm going to put only at 2% because things have been going up so rapidly and they've kind of evened out, if not fallen off over time. But I think over the 7 years, it'll still continue to go up some. The expense escalator, I'm going to put that at 4%. So now over time, they're diverging just a little bit. The other big one that I'm going to do is this terminal cap bump per year. They've got it at nothing, and I'm going to make it a 0.1%. So essentially it's saying every single year, if I were to buy that same cash flow, it's going to cost me less and less. Or another way to say it is, if I were to sell this cash flowing asset at the exact same amount, I'm going to get less and less for it each year. It's just a way of being conservative on my assumptions. And I really think I could hit the 7.2% market cap rate here. Not a problem, which is the goal, right? I want to be able to confidently say, yes, I could absolutely sell it for this rate. And now for the final ginormous assumption that has to be added to this model. To say that there are zero costs to go in to fix this building just isn't reasonable. I can look at a picture of the outside and I can tell that there's going to be some work needed. And I can look at the pictures on the inside and I can tell that there's going to be some updating that's going to be needed. At least I think so. I don't know. Maybe people are into the eclectic, hey, let's keep this kind of old as long as it's in good shape type of thing, potentially. So I will be nice. And in this particular case, say we're going to paint and repair the outside, and we're going to do a little bit of stuff on the inside. And so I think that's going to be a nice happy middle. So for the exterior budget, we're going to do $2,500 per unit, which is a pretty standard practice for what we'll put in. And for the interior, we're going to go cheap. We're just going to spend a couple grand on each unit. We're not going to go crazy. We're not tearing down walls. We're just maybe refreshing a few appliances, maybe doing some nice little fixes, something like that. And for the moment, I will concede that the vacancy loss isn't going to be the typical 15%, but I do think that I should go with what at least half of that normal assumption and put it at a 10% vacancy loss. So those are all the bad things I would put into this model. Let's take a look at how this investment now looks. Yeah, that is pretty bad, obviously. And that totally makes sense. You could probably even see that the break even and estimated are they're razor thin. You would have to manage this property perfectly in order to pull off something like this. It'd be really, really hard to do. But I think there's one more change that we could make that could potentially turn this investment around. So if we head back to the underwriting model, there's this RUBS section, which is the ratio utility billing. I don't think that I could potentially get all of this, but potentially. And so let's put that in there and see what it is. Now, I can't do all of this in the first year because people are on leases and things like that. So I need to change the stabilization month from 12 months, saying I'm going to do all these repairs in the first year, to let's say 24 months. So it's going to do two things. Number one, it's going to spread out how long it takes me to do the development costs, but it's also going to spread out how long it takes me to increase the rents, including now doing back these utility billings. This is probably the closest that I could get to saying this is the realistic what I think this property will do, given all the assumptions that I'm seeing. So just to recap, we're buying it for $829. It's 6 units. We're holding it for 7 years without a refinance. We're going to spend $27,000 over 2 years to complete an update. And so we're going to spend a total of $900,000 on it. And as you can see, the results aren't great given these assumptions. It essentially is losing money for you. You are much better off to put your money into another investment. You actually will end up with less money than when we started, which is kind of crazy that would happen. And a lot of that is driven by this target exit price. Perhaps it could be worth more. I don't know. And the biggest problem you run into is that over time, you can see that this gap between what rent is getting and the expenses, they are closing. And that's because of those different ratios. What's it going to be over the next 7 years? I don't know. Maybe rents will continue to skyrocket back up and those things will flip. Maybe we will get inflation under control and these expenses will go back down to like the 3 to 2%. I don't know. But this is a conservative look at what this could look like. Could you get a possible 29% or 20% cash on cash return? No, I don't think so. As we saw, just simply making one change in the expense line totally changed the entire output of this thing. And when you start to dial in some of those other things, it just doesn't make a lot of sense, unfortunately. And I think the biggest problem, honestly, is that it's got this really big loan to value in order to try to make it work. And so if we come all the way back to the beginning of this thing, where we did this ballpark analysis and we said, okay, maybe it's 10%, and maybe this is actually 40%, and we're still going to assume that it's a 6.5% in that area. What that really means is that if I were to make an offer, it should be closer to $700,000, not $800,000. Unfortunately, I think given these assumptions, it doesn't make a whole lot of sense for me to purchase. One final thing, which is again, just to show you what it means to be so highly leveraged like this. Let's go back to this repairs and maintenance and let's put it back down to $3,000. Let's again just assume for whatever reason that number is right, and we do have a replacement reserve. So we are going to be spending and saving an additional $1,500 towards it. So it's not like it's totally we're not doing anything ever again. Here's what that summary looks like. It gets us back to more of a ballpark. Okay, this is what I would expect to see. Does this make sense for, say, my investors to get involved in this? No, it's a little low for what we're generally targeting and looking for. But we're at least in a spot where I think an individual investor who has the funds sitting around to not only do the down payment, but to also do some stabilization work on it, I think this could potentially be a really good return for them. And I could also potentially see them saying, I'm not actually going to rent out that studio. I'm going to turn that into an Airbnb. Maybe even potentially all of it becomes an Airbnb. And at the very least, now they have a spot where they can go when they're going on vacation. And so it's more of a strategic purchase where they're willing to not make a huge return, but they're also not losing money. And they love going there to vacation. I could totally see something like that also working out for an investor. For what I'm going for, doesn't make a whole lot of sense for my investment style, but that's okay. So very interesting property. I love seeing the impact of having something that's super high leverage and just how it really makes all the other dials super, super sensitive. Thanks for watching, and please like this video if you found it helpful. And if you would like more tools and tips to maximize your long-term cash flow while minimizing headaches, please subscribe. Thanks for watching.